Hello, everyone. Welcome to another Atlas Annuity Strategy video. I'm Marty Becker, and today we're going to talk about something super important that I've kind of dropped the ball on because I really didn't see the value in the type of products that were offered in the past. But there have been some dramatic improvements to a category of coverage that could have a drastic impact on the overall outcome of your financial well-being, and that's long-term care insurance. You see, at the end of the day, no retirement plan is complete without long-term care insurance. And here's why. The odds that you'll need it someday are staggering. Just look at these statistics here. You have a 3% chance that you will lose your house to a fire, but I bet you have home insurance. You have an 18% chance that you'll total your vehicle in an auto accident, but I bet you have car insurance. But take a look at this. You have a 72% chance that you will need some type of long-term care assistance, but yet less than 30% of Americans have long-term care insurance. So just like you want to insure your home or your car to avoid a catastrophic financial loss, long-term care insurance provides the same type of protection because the average cost of a single-room skilled nursing facility is over $100,000 per year. And remember, there's a 72% chance you're going to end up in some type of scenario where you need assistance. So considering the odds are greatly against you not needing it, you better start coming up with a plan to cover it. And there's only 3 ways to pay for long-term care. Number 1 is self-funding. This is probably the worst plan to have because all but the most affluent families can really afford to do this without bankrupting themselves. And even if you do have the money to self-fund, wouldn't you rather do it for pennies on the dollar and protect your assets? Number 2, self-fund until you run out of money. The problem with that is you'll get transferred out of your clean and cozy care facility to a Medicaid facility once you run out of money. And I'm going to talk about why you don't want that to happen in just a second here. Or number 3, you transfer all or part of the risk to an insurance company and let them pay for it. That's what they do. So who am I and what even gives me the right to talk about this subject? Well, I have a unique perspective in this area because I've been a licensed paramedic since the age of 20. I've been in the fire and EMS service since the age of 23, and I have responded to 911 calls at skilled nursing facilities hundreds, if not thousands of times. Now, I'm still active in the fire service as a captain in St. Louis County, and I still respond to these types of calls. I started Atlas due to a loss in my defined benefit pension system, and I had to find an answer to my own retirement crisis. So even at the beginning of my business career, long-term care was an option for me to offer my clients when helping them with their retirement strategies, but I had no desire to sell a product that would have an increasing cost as time went on and could eventually cause my clients to lose their coverage because they could no longer afford it. I just wasn't going to do it. But there have been some major improvements over the years with some options that allow you to use a lump sum or have a guarantee that your premiums will never go up. And now I can no longer ignore this subject because I know from firsthand experience what happens if you don't have it. Okay, so why do you want or why do you even need long-term care insurance? Well, it's pretty simple. Because if you don't have a plan for long-term care, the government has one for you, and you are not going to like it. In fact, ask yourself, when have you ever liked anything the government has stuck their nose in? Do you like going to the DMV or dealing with the IRS? Because if you think dealing with those places sucks, just try and imagine what a government-run health facility would be like. Anyone who has ever had to deal with a VA hospital knows exactly what I'm talking about. Now, nothing against those doctors or nurses that work there. They're doing the best they can, but it's an extremely inefficient form of service. So yes, long-term care could devastate you financially, but it is so much more than that. It literally could mean the difference between spending your most vulnerable years in a Hilton versus Section 8 housing. And here's what I mean by that. What I noticed in my time responding to these different facilities is that some of them are clean and they smell good and they have nice people working there and they have activities for the residents and competent people providing care. That the employees actually care about the well-being of the residents. And then some of them have some of the most incompetent, ignorant people working there that I've ever met in my entire life. The smells are atrocious. I mean, like a punch in the face as soon as you walk in the door. And if your senses are not being inundated by urine or feces, you're catching a whiff of cigarette smoke or weed. And that's just when you walk in the front door. As you start to walk the halls, you hear people screaming for help. And there's random people just sitting there in wheelchairs, just staring at the walls because that's where they were left by the staff. And let's not forget the neglect and abuse that happens in these Medicaid facilities. People who fall out of bed or have been short of breath and running a fever for 10 hours because no one has checked on them, even though they've been yelling for help continuously. And when the resident is finally able to call 911 on their own because they got to a phone, where are the so-called, quote, professional care providers when we arrive with the ambulance? They're way at the other end of the hallway watching TikTok videos. Oh, and then when you go to confront them about what is happening, that's normally when you start to smell the weed and the cigarettes. We just had one patient a few months ago that had just returned from a surgery and hadn't had his pain meds in over 24 hours because the meds just magically never made it to the facility. They got lost somewhere, which is just code for one of the workers stole them. And this poor guy was just sitting there in immense pain and sweating profusely after having his abdomen sliced open just 36 hours earlier in surgery. And if you think that you'll get to endure all that misery in the privacy of your own room and that'll be okay, think again, because you're going to share a room with some stranger. And you need to just pray to God that you don't get paired with some psychotic like the one we had that tried to kill his roommate with a soda can that he ripped in half and turned it into a razor blade. Now, these are true stories, people. And the neglect and abuse in these types of facilities is so egregious that it's enough to even make Mother Teresa drop an F-bomb on these people. And guess what happens when we report these facilities to the state? Yeah, you're right. Absolutely nothing. And I used to think it was because the people in the nice facilities were rich and the people in the crappy facilities were poor. That's part of it, but it's not the whole story. You can prevent this from happening to you or a loved one by using long-term care insurance that's customized to your specific situation. And please don't take this as some sort of fear mongering so I can make a sale or anything like that. I would be totally fine if I never sold anything from my business ever again. I have a set income through the fire department. I'm totally fine. But these are real situations, and it is a reality that the vast majority of people are going to have to deal with at some point. So there are two main benefits to long-term care insurance. Obviously, there's the financial protection, but then there is the emotional protection. And that entails you being able to stay in your own home, which you can use long-term care insurance for, or a facility of your choosing. Plus, you can remove the burden placed on family by having to take care of you physically or financially to keep you out of one of these facilities. But the most important part is allowing you to keep your dignity as a human being and not end up in a government-run facility. So, how does all this come together? There are three main pillars to long term care. Number one, maintaining control of your care. Number two, correct funding. And number three, protecting your net worth. Okay, so pillar number one is maintain control of your care. First thing we have to do is overcome some common misconceptions that Medicare pays for long term care. That's wrong. Medicare will only cover days 1 through 20, and that's if a doctor says you have to go into some sort of rehab facility. Days 21 through 100, Medicare requires you to kick in on that tab, which for 2023 is $200 per day. After day 100, you're totally on your own. And any income or investable assets are on the table to pay for your care. And that's including assets that are jointly owned by your spouse. But again, the biggest problem with this scenario is that eventually you end up in a Medicaid facility. And of course, the whole point of this is to keep you from going into a Medicaid facility for your own personal well-being and all the reasons that we just talked about. But protecting your asset is the other main benefit. And I know there are people out there who have some plan put together to give all their money away so the nursing homes can't get it. And there are plans out there to do that with the help of an attorney. But remember, you're going to pay pretty big for that type of service. But what actually happens to your money before Medicaid kicks in and starts paying for your care? The first thing Medicaid will do is a 5-year look back to see if you've been hiding money by giving it away. And then they will comb through your personal items to make sure you didn't spend it on a bunch of luxuries to try and hide the money. Now, this just sounds like a very intrusive process by letting the government come into your home and look at your personal finances. Then, all income in your name and jointly earned will be up for grabs. So unless your spouse has their own pension or investment income with their name on it solely, that money is on the table. And if they don't, Medicaid only allows for a couple $1,000s per month for your spouse to survive on, which I'm not sure how anyone does that. Plus, any jointly held investments will be spent down to around $137,000 before Medicaid will even kick in and start paying for the care. So basically, they're going to take everything possible before they will pay out a single penny in assistance. And what's worse, if you do not have a spouse, they will literally take everything with the exception of about $2,000 that you can keep in your checking account. And if you're married, once your spouse is gone, anything left over, including the value of your home, will be on the table for Medicaid to take and try to get reimbursed for every dime they paid out for your care. So literally going on Medicaid equals self-impoverishment. But all of this can be avoided with pillar number two, which is correct funding. So correct funding, maybe one of the reasons you have not considered long-term care is that you thought you couldn't afford it, or you were afraid of the premiums getting so expensive you would have to drop it. And not only would you lose the benefit, but you would also lose all the money that you paid into it. But like I mentioned before, there have been a lot of improvements that allow you to either fund a policy with a lump sum and never pay into it again, or to have a level premium that will never increase and can be paid over a 5, 10, or even a 20-year period. And then the benefit can never be lost. And at the end of the day, it's really too expensive not to have it. Because do you remember what the chances of you actually needing it someday? 72%. And there are a lot of options out there. Some will allow you full liquidity of your money if you ever need it. These normally provide the smallest benefit, but have the most flexibility. Some have a little less liquidity, but have a better benefit. Then others do not offer much liquidity of your money, but have the highest benefit. But all of them have the opportunity for growth to increase the death benefit, the cash value, and the long-term care benefit. So regardless, someone is going to get the money. It doesn't just disappear like in traditional long-term care. So either you receive the benefit of services for long-term care, or you have the money returned in cash, or your family gets the death benefit. Plus, most people are unaware that you can actually use qualified money from a 401k or an IRA to fund one of these policies. So that's a huge development as well. And then finally, pillar number 3 is increasing or protecting your net worth. And for this one, we're just going to take a look at a couple case studies. So Joe and Lisa, 68 and 62 years old, with $650,000 in investable assets. Unfortunately, Joe develops Alzheimer's after 5 years of the retirement. Lisa then proceeds to spend $58,000 a year for in-home care assistance for the next 10 years. That only leaves Lisa with $70,000 of investable assets in addition to her Social Security. Now, we're not assuming any losses or gains. That's a different conversation. But if they would have had a single premium long-term care insurance policy, they could have secured $600,000 in benefits for $150,000. With the triple benefit enhancement, Lisa still would have $370,000 left over for her retirement in addition to her Social Security. Now, what would have happened if Joe did not get Alzheimer's? The benefit and the cash value would have remained for future long-term care, liquidity, or a death benefit for their beneficiaries. Now, our next case study is Jerry, who is a 65-year-old man and has a pretty substantial amount of cash just losing value against inflation in the bank as an emergency fund. Now, I explained the concept to him of moving money from the right pocket, the bank, to the left pocket, which is a single premium long-term care policy. So instead of letting the money just sit there making nothing, he can change the location of where the money is being stored, and he immediately increases his legacy and his long-term care coverage by 109%. And he did that by literally just moving the money to a different location. And as time goes on, his absolute worst case scenario over the next 30 years, meaning this is the guaranteed part, is a return of 1.59%. Now, what was he making in his savings account? Not 1.59%. And that's if the indexing strategy literally does nothing for the next 30 years, which is very hard to believe. Okay, but he has that money sitting in the bank for a reason. He wants a safe pile of money for emergencies, right? Well, while the money is in the long-term care policy, he still has the option of a 100% return of premium. What that means is he can literally get all of the money back at any time that he wants, with no penalties, no repercussions. Or he has the option to take a 10% penalty-free withdrawal without surrendering the policy. So if he just wants 10 grand to take a trip or something, but doesn't want to give up the coverage, he can do that. But what if he has like a quick real estate investment and he wants to flip a house or something and doesn't want to give up the coverage of the policy, but needs the money for a short time? Well, he can also take a loan against the policy of up to 60% of the value and pay it back in his own time frame. Now, they will charge an interest on that loan, but obviously he is doing it with the intent on paying it back in a timely manner and making more from the investment than what the interest rate would be. But His main goal is not to give up the long-term care protection. And of course, he has the opportunity for policy growth with indexing performance and increasing the long-term care coverage, the cash value, and the death benefit without any risk to a stock market crash. So this is a really, really cool product. Now, those are just two examples of what's available because I wanted to keep this video somewhat short. However, we can do a custom design plan using the Atlas LTC strategy, where we will take a look at your finances and get you the perfect amount of coverage to not only protect your money, but again, protect your dignity. I will give you a comparison of what's available and help you pick the best option for your situation. And by using this customized approach, we're not only going to protect, but we will see if we can leave you and your beneficiaries in a better position than when we started. So all you have to do at this point to get your customized Atlas LTC strategy is reach out to me by going to www.atlasannuity.com, and that will take you directly to my calendar page. Or you can call 636-926-6500. I will, however, recommend that you just book a time through the website instead of trying to call. Most days, I just don't have time to answer the phone. But if you leave a message, I will try my best to get back with you in 24 hours. But honestly, you're better off just booking a time because that way you'll have my full attention and you'll be able to get your questions answered. And if you haven't already, download a free copy of my LTC Atlas by clicking the link at the bottom of this webpage that is highlighted in yellow. And if you just happen to come across this video on YouTube, you can just go to the atlasannuity.com page and click the video section, and you should be able to find it there. Again, this is Marty Becker, owner of Atlas Financial Strategies in St. Louis, Missouri. Thank you for your time. I hope this video finds you well, and I wish you all the best.